Since 1990, farmland has delivered average annual returns of 11.5%. It has never posted a negative return over any rolling decade. It outperformed the S&P 500 real estate investment trusts, gold and bonds over the last 30 years, with less volatility than any of them. And almost nobody talks about it. Welcome back to Capital Above Convention. Today we're going deep on farmland, one of the most overlooked, misunderstood, and historically consistent asset classes in the world. This is the asset that Bill Gates has quietly become the largest private owner of farmland in the United States. The asset that Harvard's endowment, TIAA, and sovereign wealth funds from Abu Dhabi to Norway have been accumulating for decades, and the asset that most retail investors have never considered for a single second. By the end of this video, you'll understand exactly why and how access to this asset class is fundamentally changing. Let's start with the fundamentals. Farmland is exactly what it sounds like. Agricultural land used to grow crops or raise livestock. But as an investment, it operates like a combination of real estate and a commodity business. You own the land, which appreciates over time, and you earn income from the farming operations conducted on it, either by farming it yourself, leasing it to a farmer in exchange for rent, or through a crop share arrangement where you receive a percentage of what the land produces. This dual return structure, appreciation plus income, is what makes farmland uniquely attractive. And it sits on top of a supply and demand dynamic that is, structurally speaking, one of the most compelling in any asset class. Here is the supply side of the farmland equation. The total amount of arable land capable of supporting crops on Earth, is fixed. It is approximately 1.4 billion hectares. That number is not growing. In fact, it is shrinking. Urbanization, soil degradation, and climate change are removing agricultural land from production faster than new land is being brought into it. According to the United Nations Food and Agriculture Organization, the world loses approximately 12 million hectares of arable land every year to degradation and desertification. Now look at the demand side. The global population is projected to reach 10 billion by 2050. A growing middle class in Asia and Africa is shifting dietary patterns toward more calorie-intensive foods, meat, dairy, processed goods, which require significantly more agricultural land per calorie to produce. The Food and Agriculture Organization estimates that global food production will need to increase by 50 to 70% by 2050 to meet this demand. Shrinking supply, growing demand. This is the structural tailwind that sits underneath farmland as an investment. And it is not a trend that reverses in a recession, a rate cycle, or a geopolitical shift. People need to eat regardless of what the Federal Reserve does with interest rates. This is why farmland has the return profile it does. The 11.5% annualized return since 1990 is not a coincidence. It is the mathematical expression of a structural imbalance between the supply of productive land and the demand for what that land produces. And that imbalance is getting wider, not narrower. Let's talk about why institutional investors love farmland beyond just the return numbers. First, inflation protection. Farmland is one of the most effective inflation hedges in existence. When inflation rises, food prices rise. When food prices rise, the value of the land that produces that food rises with it. The income generated by farmland through crop sales or lease payments also tends to rise with inflation. This is the opposite of what happens to bonds, which lose real value when inflation accelerates. In an inflationary environment, farmland is exactly where you want to be. Second, low correlation. Farmland returns have virtually zero correlation to public equity markets. The 2008 financial crisis, the 2020 COVID crash, the 2022 rate shock. In each of these episodes, while stock markets fell 20, 30, 40%, farmland values were stable or rising. This is because the fundamental drivers of farmland value, food demand, arable land scarcity, are completely disconnected from the sentiment and liquidity dynamics that drive equity markets. Third, income stability. The lease income from farmland is remarkably consistent. Farmers sign multi-year leases. They pay regardless of what happens in financial markets. And the land itself, the physical asset underlying the investment, cannot go to zero. A stock can become worthless. A bond issuer can default. Farmland will always be farmland. These three characteristics together, inflation protection, low correlation, and income stability, explain why the world's most sophisticated institutional investors have been quietly accumulating farmland for decades. Harvard's endowment built a significant farmland portfolio. TIAA manages over $37 billion in global farmland assets. The sovereign wealth funds of Gulf states, Norway, and Singapore have all made substantial farmland allocations. Now the risks, because farmland is not without them. The first risk is illiquidity. Farmland is not a public market. You cannot sell a farm in an afternoon. Transactions take months. Finding a qualified buyer, conducting due diligence, navigating regulatory requirements. This is not a liquid market. If you need capital quickly, farmland will not provide it. This is the same illiquidity premium dynamic we discussed in our first video. You are compensated for accepting illiquidity with superior long-run returns. The second risk is operational complexity. Owning farmland directly means dealing with tenants, crop yields, weather events, irrigation systems, and regulatory frameworks. This is not passive income in the way a stock dividend is passive. Successful direct farmland investment requires either deep expertise or the right management partners. The third risk is concentration. Farmland is highly location specific. A drought in the Midwest, flooding in the Delta, a pest outbreak in the Valley. These local events can significantly impact returns on a specific piece of land. Diversification across geographies, crops, and farming systems is essential to managing this risk effectively. So how do investors access farmland today? The traditional route is direct ownership, purchasing agricultural land outright. This requires significant capital, typically starting in the hundreds of thousands of dollars, and significant expertise. It is the domain of family offices, institutional investors, and agricultural operators. The second route is through farmland REITs, publicly traded real estate investment trusts that own agricultural land. Gladstone Land and Farmland Partners are two examples in the United States. These offer liquidity and low minimum investment, but come with the correlation to public markets that direct farmland ownership avoids. The third route is through dedicated farmland platforms, companies like AcreTrader, Farm Together, and Harvest Returns, that allow accredited investors to buy fractional ownership of specific farm properties for minimums as low as $10,000. These platforms handle the operational complexity, provide income distributions, and target investment horizons of 5 to 10 years. The democratization of farmland investing is real and accelerating. An asset class that was accessible only to the ultra-wealthy and major institutions a decade ago is now within reach of serious individual investors willing to commit patient capital. 11.5% annual returns, no negative rolling decade in 30 years, structural supply-demand tailwind, inflation protection, zero correlation to equities. The most boring asset in the world is also, by many measures, one of the best. Subscribe to Capital Above Convention for weekly deep dives into the alternative assets that serious investors use to build and protect wealth. And I'll see you in the next one.